Friends, I welcome you all to our today's session. So let us continue our discussion on errors and frauds. Earlier, we have already understood what are the various types of errors and frauds, and it is also important that in which context we are understanding these types of errors and frauds. The context is that auditor is supposed to give his opinion on the financial statement, and this financial statement can be misstated, or that means it may not be showing true and fair view. Why it may not be showing true and fair view? Because it may contain certain misstatements, and these misstatements arises either due to fraud or due to error. Okay, so this is how the error and fraud is connected to the auditor's opinion. So because of errors and frauds, there might be misstatement, and that misstatement again we have to see maybe material. If it is material, then financial statement may not be showing true and fair. Okay, so earlier what we have seen, if I share the screen with you right now, we have also understood these are various types of error or fraud, like self-revealing error or fraud, intentional error, unintentional error or fraud, or unconcealed or concealed error or fraud, and error and fraud which are affecting the general ledger balance and which are not affecting general ledger balance can be called as procedural errors also. This is one way we can classify. We have discussed all these things, right? And coming to a particular fraud, which is called as a defalcation of cash. In that context, we have seen there are three situations. Like it can happen, one may defalcate cash by inflating the cash payments, by suppressing the cash receipt, and one method also we have discussed, which is popularly called as teaming and lading method, and by doing wrong casting in the cash book. One can defalcate cash. These possibilities we have discussed earlier. And fraud may occur through misappropriation of goods also. And here one context, we know that it is misappropriation of cash may be little easier to detect, but misappropriation of goods is little difficult to detect. Okay, most of the cases when this kind of thing happens, the fraud happens. Sometimes we see that higher management is involved, and in case higher management is involved in a fraud, then it is difficult to detect. It's a little more difficult to detect those frauds. Procedural errors, and these are the okay. One more type of errors, like errors of omission, commission errors of, or compensating error, errors of principle, and procedural errors. All these things we have discussed. Okay. These 5 types of errors I had explained you earlier. Then let us today let us start from this point. One thing is that the fraudulent financial reporting and misappropriation of assets. These are the two possibilities of fraud. Fraud may happen in the area of financial reporting, or asset might have been misappropriated. Okay. Now, in that context, why this thing happens? There might be certain circumstances like incentive and pressures, or there might be opportunities, or there might be attitude of the management is to commit fraud like this, or management tries to rationalize or try to justify the fraud. So these are the below these 3 points which you are saying here, these are in fact, these represent the circumstances in which fraud occurs. The first situation we'll see. First one is incentive or pressure. This thing also basic level we had discussed. If one may feel the situation is like that, there is some incentive if fraud is committed, or there is tremendous pressure on the management to commit fraud. Situation might be like this: there's a high degree of competition, or there is market saturation, or the entity is incurring some operating losses, or there is a need to obtain additional debt, or in order to comply listing agreement, or maybe personal guarantee as regards to debt is affected, personal guarantee of directors or other people are getting affected. If these situations are there, you can say there is some incentive or there is some pressure on the management to commit. Okay. Heavy competition. By committing fraud, one may artificially show higher sales or artificially show more profit in competitive situations. Or there is an operating losses, there is a threat of bankruptcy, one may temporarily avoid that thing, temporarily hide that thing by uh, misstating something in the financial statement. So that's the incentive, temporarily hiding something. Then, if there is some need to obtain additional debt and the financial statement of the entity is not permitting, then management may decide to commit a fraud and to represent the present the financial statement in such a way that additional debt can be obtained. Okay, maybe sales is improved, or maybe current ratio is improved, or asset position is improved in a wrongly enhancing these positions. One may obtain an additional debt. Okay, sometimes to comply with the listing agreements requirement, financial statements are also missed. And also many times to protect the personal guarantees which are generally given by the directors, financial statements are missed. Understood this situation? When you can say there is incentive or pressure on the management to commit fraud. Did you understand these situations?
So can you explain compliance to listing agreement?
Compliance to listing agreements. Okay, let us say listing agreement many times says quarterly reporting, unaudited reporting. Okay, quarterly, let us say unaudited figures has to be disclosed. And management finds that audited figures are substantially different. The management may like to stick to the figures which are disclosed in the unaudited financial statements. Otherwise, the stakeholders may feel that the results, unaudited results which the company has published, that is fake, that is not correct. Are you getting me? Yes, have you seen the management listed companies, they publish their quarterly financial results unaudited. Okay, limited review reports they publish. But practically when accounts are audited, they may find something is wrong. That means these figures are different. So in that time, management may be tempted, or there may be pressure on the management to stick to the unaudited figures. Okay. So if this, let's say as an auditor, you are visualizing these are the possibilities. If fraud is committed, there is some incentive, there is some benefit, or there is a pressure on the management to commit fraud. So auditor needs to be more careful, more skeptical. Excuse me. Right? Similarly, next situation is that you can see if there is opportunities, that means chances are there, management can commit fraud. How there is possibility? There is significant related party transactions. That means lot of transactions, high value transactions are with related parties, maybe through group companies or maybe with the relative of the promoters. There are certain transactions. If this kind of transactions are there, there is chance or there is opportunity to commit fraud. Okay, transaction may be purposefully booked at high value so that profits of one entity can be transferred to the other entity. Right? So a particular product or services, if it is sold at a higher value to another entity, then what happens? One entity loses, another entity gains. Did you understand it? Or should I explain it with the help of example again? I think last session I had explained it. Do you need explanation?
No, sir.
Okay, right. So if there is related parties are involved, then the transaction value may be manipulated in the sense the real sales, let us say 10,000 rupees, but practically it is sold as 50,000. So one company is having excess income or excess profit, another company is losing in that process because he is buying at a higher price. So there is fraud from both the sides, and both the financial statements will not be showing true and fair. But nobody will object because it is a related party transaction. And there is opportunity to commit fraud. Isn't it? Let us say one company is earning more profit and he has to pay tax. It may purposefully incur loss by doing some related party transactions, so that one company's profit is transferred to another company. Understood this? Okay. And also, let us say transactions are such that there is significant estimates are involved and subjective judgments are involved. Uncertainties are there as regards to financial figures. And these areas management has to estimate. When estimates are involved, there is always possibility of fraud. There is opportunity to commit fraud. Sorry. And third case is that if there is significant, unusual, and highly complex transaction, where it is difficult to find out what is substance over form, that means what is the real nature of the transaction. Is it a sale or is it just a transfer? Something like that. In those kind of transactions, since the transaction is complex, transaction is quite complex, in that situation, there is opportunity that management may interpret the transaction in such a way that it will be helpful to him, helpful to the management. Okay, accordingly, the financial statement may be purposefully misstated. With this kind of opportunities, the chances of committing fraud is high. The third situation is that attitude or rationalization of the management. In case one finds, or the auditor finds, there is non-financial managers' excessive participation. That when managers who are not involved in the finance, they're excessively participating in auditing decisions. They are interacting with the auditors. Or one can see there is a history of violation of law in that entity. There is every possibility the fraud may be committed. Or one might see that there is significant changes in the lifestyle of the managers. So these things indicate that there may be some fraud. Okay, we talked about these situations. Now, let us quickly discuss some circumstances that indicate the auditor gets an indication that fraud has been committed. Previously, what we were discussing about certain situations. In this situation, there is a possibility of fraud. Okay. But these indications of the circumstances indicates and circumstances show that there is fraud. For example, from accounting records, you can get some information. Like, let us say transactions not recorded completely or timely. Accounting transactions are not timely recorded, or transactions are not complete. This is enough indication that fraud is committed. Or unsupported or unauthorized balances. Balance sheet shows figures, but there is no support. If you go for physical verification of asset may not be there. Or some other evidence you search, you are not getting it. And one may find last minute adjustment. On 31st March date, you can find so many journal vouchers are passed. Or one can find there is inconsistent access of employees to systems and records. Okay, different people at different point of times are given access. Which situation doesn't warrant. Or there are tips or complaints to auditors. Some employees might have given some tip or some complaint that this kind of fraud has happened. So these are indicators of. Another group of indicators might be if there is some conflicting or missing evidence, missing documents. Documents are not found. Documents found, or it is found to have been altered. Somebody might have tampered that document. Or one may think of a situation that photocopy documents are shown to the auditor in the place of original. Okay, auditor is insisting for the original document, but the entity is showing only photocopies. These are again indications. Another group of indicators are there in the area of problematic relations. If there is denial of access to records, the entity is denying to give access to the records, that also indicates fraud. Or there is undue time pressure imposed by management. Management is imposing to complete audit within a very limited time, which is very difficult to achieve. So if that kind of undue time pressure is there, so that also indicates that might be some. Or if there is unusual delay in providing information, either management is not providing information or there is excessive delay in provision of information. That also indicates a circumstances of fraud. Or denial to access to IT operation. Auditor is not giving access to the computer system. Okay, entity is saying whatever you want, you ask me, I'll provide you, but directly you should not access to the IT system. So these are again a group of circumstances that indicate fraud. There are some other indicators also, like unwillingness to meet privately. Okay, some people or some employees are not meeting auditors privately. They are coming in groups, always in groups. Because in private meeting, if individually you meet, they may contradict to each other. So if no one is willing to meet privately, there is an indication that fraud might have been committed. There might be some. One may find variance in accounting policies. Accounting policies are not consistent. It keeps on changing. This year, revenue is recognized in a particular way. Next year, accounting policy changes. Revenue recognition policy changes. If that kind of inconsistencies are there, that also indicates fraud. Or frequent changes in accounting estimates. Accounting function involves estimates. And if there are frequent changes in accounting estimates, that also indicates. So this year we are saying the life of asset is 20 years. Next year saying 25 years. Next year saying no, 18 years. So that indicates fraud because all this estimate has impact on the entity's profitability as well as position. Okay, by changing these estimates, one may change the profit, one may change the asset positions. So they also indicate fraud. Understood, friends?
Yes, sir.
Okay, is it clear to you up to this?
Yes, sir.
Practically, you try to visualize the situation. If you are the auditor, this kind of indication you get, that means there is a fraud. Okay, you may have a look at this. Fraud may happen in two areas broadly: fraudulent transfer reporting and misappropriation process. Okay, circumstances, there may be incentive or pressure, there might be opportunities, or attitudinal rationalization of management. Okay, is it clear up to this?
Yes, sir.